All right. Thank you, everyone, for joining us today. I'm Brenda Moss, and we have Mike Morgan here. And of course, Mike, I'll let you get started with the presentation.
Okay. And just like Brenda said, thank you everybody for joining in. This is our second webinar since we formed Morgan and Moz, second of many to come. And I do see a few names that attended our first one. I just want to say I appreciate you guys coming out for this one as well. It shows we must be doing something right. But today we're going to be analyzing small multifamily deals. We're going to be going over things that you as an investor need to look for and check into on your own. We're just going to, cover some basics on some things and give you some, different scenarios to look at today. So we'll go ahead and, like I said, it's Brenda and I. So here we are. We're going to go ahead and get going. And on the agenda today, we're going to discuss why multifamily, what's the reason so many investors go for multifamily, what's the profits like, things like that. Multifamily versus single family, what the pros and cons are there. The financing of the deal, we'll talk about that. Things that you need to look for to, when you're looking for a good deal and trying to find the financing, the pitfalls that you may run into there. We're going to go over things like that. Of course, determining the value of the property. We want to make sure it's a property that's valuable to you, that's going to have a good ARV and work for your numbers. We'll go over your pre-inspection review, the things that you need to go into and look at to determine whether this is a good deal for you or not. Then, of course, analyzing the deal and have some samples in there, like I said. And at the end, we'll open it up for some questions and answers. And anybody has anything they want to know, we'll go ahead and answer it the best we can. But without further ado, we'll go ahead and get on into it and introduce each other. Again, I'm Mike Morgan. I've been in real estate for about 3 years now. Been on the investing side for going on a year and a half. I just love what I do. Met my partner Brenda through investing here in the Chattanooga market, and that's how we formed Morgan and Moz. And if you want to kind of introduce yourself, Brenda.
Absolutely. Thanks, Mike. So I've been in multifamily really my entire adult life. I've been professionally involved in development and have over 3,000 units developed throughout California. I also syndicate, so we have various syndications within Texas, primarily California, and we have investments as well in Tennessee and Georgia. I mainly do asset management, overseeing the operations for our entire portfolio. So we have over 80 investors, and that's pretty much what I do all day, is really locate investments that make sense for out-of-state investors, but also local investors within California as well. And that's how, Mike and I came together, is we're trying to bring those out-of-state investors that are looking to invest outside of really expensive regions into areas that are growing, where there's population growth, there's job growth, such as Chattanooga, and find those investments so that, they can build their portfolio, build their wealth, but also take advantage of all those tax incentives, which we're going to go over today as well.
Okay. Why multifamily? What's the real estate market like here in Chattanooga? You have to scale your portfolio. With multifamily, it increases your cash flow a large amount more than single family. The potential for appreciation, and I'd like to throw in that as far as appreciation in the Chattanooga market, we kind of have a hybrid market for appreciation. We have your property appreciation, then we also are having appreciation from population growth. There's so many people moving to the area or buying rental property in the area, helping things grow like that. Can introduce you to some easier financing options when working with multifamily. The tax benefits, like Brenda said, we're going to go over that a little bit today as well too. Brenda, you want to say something on the housing affordability crisis?
Absolutely. So housing, multifamily housing is really something that I really dig deep into. I follow the market very closely. And so as we all know, it's very difficult to buy a home these days. So what it's doing, it's really causing a pool of renters, right? Renters who cannot yet afford to buy their own homes. So the demand is really there for multifamily at the moment. And so also we have this huge affordability issue where rent is also increasing, right? So we have renters who are pretty much stuck. They're putting a lot of their livelihood out every month to be able to afford their rent, which means they're not saving to be able to buy a home. And those homes are actually quite expensive nowadays, especially with high interest rates. So we have this affordability issue that's only going to continue to bring the demand for multifamily even higher. And obviously that also talks about lack of housing. We just don't have enough housing being built. Even though this year is going to see a record number of multifamily coming online, that's because in 2001, 2002, a lot of developers started building apartment buildings. So all those apartments are now coming online this year and next year. However, because of the high interest rates, we're going to see a huge drought in 2025 and beyond, because there has been very little bit of new product that has started construction because of the high construction rates are about 9% or so just to be able to get that loan. So a lot of developers have to shelf a lot of their projects. Unfortunately, that means it's going to create a bigger inventory issue down the road. But that also means there's going to be even more demand for housing. So we just see a very long-term issue here with affordability. And that just means there's going to be a lot more renters going forward. But the good news is, as of today, there have been a lot of REITs that have come out and said, you know what, we've hit the bottom, right? So we saw a huge dip because of those interest rate hikes, but now we've hit the bottom. So now we're going to reset. And we've gotten maybe a 30% discount of pricing of what it was back in 2021. Most of the deals that we're seeing now are deals that have been in trouble. However, we're hitting the bottom and we're now seeing a new cycle, is what they're calling it, a new cycle in multifamily, where now we're going to see an increase in pricing going forward. So we can pretty much determine that this is probably the lowest we're going to see multifamily pricing for a bit, and we're going to expect it to only get stronger going forward. So this is a really good time for us to host this webinar for those of you that are interested in really growing your portfolio. And of course, we're going to be mentioning different classes of multifamily, but I know that the majority are really interested in just being able to transition from single family over to the smaller multifamily, whether it's the 2 to 4 units or the 5 and above. And there are distinctions. And so that's why we're hosting this webinar today, is really to help you understand what those are and help you prepare so that when you are ready to hit that market, you have all the tools that you need. But more importantly, there's really no reason why you can't get started today on that 2 to 4 unit. And we're going to be able to show you why today. So let's jump right into multifamily, the distinctions, right? So with multifamily, you can really hire a professional management company. And this is really helpful. These are people that are trained not only to be able to deal with conflicts between tenants, they're able to deal with those nightly calls on, whether their toilet's not working or not, and be able to lease your property. So these are multifaceted professionals, and it's a really difficult job. And frankly, I would not be able to do the day-to-day self-management. If you are, more power to you. That is not something that I'm interested in doing, but that's just my personal preference. And so I'd rather pay a small portion of my cash flow to a property management company who will be able to handle all of that for me. and also give me almost a passive income in a sense where I'm not actively dealing with the issues that come up. The next item is there's really a lower vacancy risk. So by that, I mean, if you have a 4-unit and one of your units becomes vacant, that's only 25% of your cash flow being directly impacted versus, if you have a single family, that's 100%. So those are things that obviously come into play, and that's exactly what economies of scale also provide, is you're able to spread the costs, the loss across the board with all the units. It's not just one impact being affected. It's really the fact that you're able to spread it and you're able to take it in consideration when you're running your analysis, that you're going to have some vacancy, you're going to have some turnover, but you plan for it, and it's not going to be such a huge punch in the gut to your cash flow every month, because some people do rely on that cash flow to live every month, right? Especially the mom and pop operators. And of course, strong cash flow, like I just mentioned. Now, higher entry costs, and I put an asterisk on this because truthfully, the higher entry cost is only for the bigger multifamily units. And the reason I say that is because of the down payment, right? So the more you pay, the higher your down payment has to be. However, we're seeing now in the Chattanooga market, for example, we have 2 to 4 units that are priced equivalent to a single family home. So this is what I mean about you can get started on these 2 to 4 units today, because the down payment for these duplexes, these triplexes, is exactly the same as it would have been for you to purchase a single family investment. And so the entry cost on that is practically the same. And next we go to tax benefits. Those are remarkable when it comes to multifamily. I think I will blow you away when we get to that slide on the things that you can do that will help you really build your wealth. And those are things that are a lot harder to do, a lot slower to do if you only own single family homes. And lastly is income-backed loans. And what do I mean by that? Income-backed means, you know what? I'm not signing on the dotted line, me personally guaranteeing the loan. This is really just dependent on how much income these multifamily units are able to generate. So that's a really good thing because it's not going against your personal debt to income, DTI, which is what the bank looks at when they're giving you a loan. This is really just based on the income that property generates. And of course, I'm talking about the 5 units and up. Now, when we get to single family homes, it's pretty self-explanatory. You self-manage these. Why? Because the basis isn't really there for you to make a good amount of cash flow, because it's only 1 unit and you really don't want to pay most of the time a property manager 10% of your earnings to manage 1 property. Sometimes these are very doable. You can handle the calls yourself. And obviously it's just 1 family. It's not a multitude of tenants that will be calling you at the same time. And vacancy risk, we went over that. Your unit is vacant, it's 100% vacant. 100% of your cash flow is impacted. Limited cash flow. What I mean by that is really you probably already rent your property at market. So there's really not going to be a lot of room for you to grow your cash flow as like there is in multifamily. And you will see that today too, how easy it can be to not just increase your cash flow, but also increase the value of your property in multifamily. Higher rates, obviously single family, the rates are going to be a little bit higher to be able to get an income property. They're not substantially higher, but you will see that the larger you go in multifamily, it's so much easier for you to get a loan to own a, say, and I'm just throwing a random number out there, a $5 million, $10 million property, than it is to get a single family. Because of the underwriting that the banks use, they will scrutinize you a lot more to own a single family home than to own a multifamily building. And again, personally backed loans. This is exactly what we're talking about. They're going to look at your debt to income ratios, your credit scores. They will go into your financials, call your employer, see how much you're making. They really dig deep in the underwriting. And of course, this is something many don't know is you're only limited to having 10 loans in your personal name. So once you hit that 10th property that you own, you're capped. So you can't own another single family. So you need to then get creative and find other ways of financing future properties. So in summary, with multifamily, you get stronger cash flow, you diversify your risk across the board, and there's a lot more appreciation potential. So tax benefits. This is where it gets, a little bit complex. I hope I don't lose some of you on this, but once you learn this, it will change a lot of the things that you may choose to do going forward, because this is really where wealth is made. And this is how, for example, you hear in the news, Trump didn't pay his taxes. Well, he legally could do that. And this is a reason why, is you are incentivized by the tax code to invest in real estate, but most definitely in multifamily. And why you can write off anything that has to do with operations, your mortgage interest, you can write off those repairs, you can write off those property management fees, you have legal fees, all of that can get written off, okay? Next thing, depreciation. I'm sure you all know you can depreciate your home, your equipment. However, with multifamily, not only can you do depreciation, you may have heard of bonus depreciation. Most people have not. So what is bonus depreciation? This allows you to take the depreciation of a building, which normally in a straight line depreciation is about 27.5 years. You can take that all on day one. And so the way you can do that is most of the time you can qualify as a real estate professional. And if you're a real estate professional like myself, that means you do this full time. You invest at least, or not invest, let me use a different word. You use 750 hours of your time every year at least to do real estate, to do your management of your properties, whether it's managing your properties, it can be talking to your property manager, looking for properties, doing, selling and buying, anything that has to do with real estate. Talk to your CPA to make sure you qualify and you document it properly, but you can take advantage of bonus depreciation. So for example, a few years ago, Trump enacted the Tax Cuts and Jobs Act. With that, we can use 100% depreciation. So that meant that if I bought a building, say, $1 million, and I could depreciate 750,000 of it, because the only item you can't depreciate is land. So that means all the improvements I can depreciate. So instead of depreciating them over 27 and a half years, I can depreciate all 750,000 on year one. So that means I can use that against, say, my husband's income, right? So he is a W-2 employee. He pays taxes on his, wages. Guess what? With that 750,000 depreciation, we can use that against the taxes that he's paid that year and not have to pay those taxes, right? And we'll still have money left that will be able, or not money, depreciation bonus left that will be able to carry on going forward in future years until it's depleted. So that is how Trump, others like ourselves, right, are able to build wealth. Why? Because we can take advantage of these type of tax incentives where we won't have to pay those taxes. Technically, you pay zero taxes, right? Because we were able to write off all my husband's active income against my passive income. So all those bonus depreciation losses get used against his active income. Guess what? We pay no taxes and we still are able to roll over the rest going forward. And the good thing about that is they're talking about bringing it back to 100% because since then they decided to taper it off. So last year was 80%. This year is supposed to be 60%. But going forward, they want to push it back up to 100% depreciation. So if you continue to invest in multifamily, you will continuously be able to do some of these strategies so that you pay zero taxes. Another item is if you don't want to use a bonus depreciation, well, you can still get 20% of your net income to be deductible. And the way you do that is you have a pass-through LLC. So what that means is I buy a property, I put it in an LLC for protection, right? If I'm sued, they only go after my LLC or what my LLC owns. They don't come after me personally. But it's a pass-through LLC, which means I own it. Pass-through means it's just the same owner owning it. There's not multiple partners, only one entity, which can be my trust, it can be myself. So this is a pass-through entity, and 20% of our rent income that comes to that LLC will also be automatically deducted. 1031 exchange. When you're ready to sell your property, all that capital gain, you won't have to pay taxes on it if you roll it over to another property of like kind. So that's another way for you to save on taxes. And guess what? You can buy another property. Now you have another investment. Absolutely wonderful. And you can do so also, you can invest using your IRA, your self-directed IRA. So this is another way for you to use your retirement funds actively and invest in real estate and grow your wealth over time without having to take any tax, or for you not to be dinged with any taxes. Now let's go into single family. Some of these also apply, right? You get write-offs. They're a lot lesser because your property's probably, smaller. You don't get as much income. You probably don't have a property manager, but if you do, you can still write those off. Depreciation is practically what everybody uses in single family. Unless your property is a higher value, you really don't go into the bonus depreciation. It's just not really seen when your property is valued $200,000-300,000 or so. You could do it, but it's really, it seems it's a much better option to do with the larger multifamilies. And of course, you can still do a 1031 exchange, and you can still do a self-directed IRA. Those are all options for you to utilize. However, I think when it comes to multifamily, being able to use that bonus depreciation and that pass-through tax deduction are really big items that will help you grow your wealth substantially over time. So now financing the deal. So let's talk about the 2 to 4 units, because I think this is where everybody wants to get started first, right? It's the easiest to get into. These are all conventional financing. Unless you're doing some major value add and you want to have a hard money lender give you the money also for the rehab, you really are going to have to convert anyhow to a conventional loan. There's really no other option. But, it's still doable. These are the easiest ones to get into because of the availability of financing. I wouldn't say easy because you do obviously get scrutinized by the lender, but the options are there. You have FHA financing. You have a lot of other options. You have a lot of these entities now that are offering you down payments for you to be able to buy these. And of course, you can house hack. You can live in one unit and have another individual pay the rest of the mortgage on the other unit. So there's a lot of good ways to get started with 2 to 4 units. Now 5 units and up. These are considered commercial properties. So here is where it gets a little trickier. The lending options for commercial are a lot different than the 2 to 4 units. And Mike will go into how these are analyzed differently, but I will tell you about the different loan options. So the hardest loan option is always the under $1 million loan amount. If you have a property that at the end of the day, you're going to have to borrow $850,000, that's a much harder loan to obtain. And those usually go to local banks and your credit unions. Why? Because they know the market and they're willing to take on the risk of giving you a loan because they do know the market. And these are recourse. So what recourse means is these you personally do guarantee them. You are held liable for these loans. And so this pocket of loans under $1 million is just a much tougher sell. And you really have to get it at a really good price to make the numbers work. Here also the rates are a lot higher. They range between 6 and 8% at the moment. The sweet spot really becomes in these loans that are over $1 million. These are non-recourse. So that means you're not personally liable for these loans. They do have bad boy clause. And what that means is you just have to make sure you are operating the property properly. You're not doing anything illegal. They will come after you if you are doing something like money laundering or anything that is against the law. However, the property fails because of lack of mortgage payment, they'll just take the property. This has nothing to do with your finances in a sense where you're going to have to be able to pay off the mortgage yourself. They do look at your finances, obviously, to make sure you can sign off on this loan, but it's nothing like buying a single family home. They really just ask for your personal financial statement, and they review that, make sure you have 10% liquidity of the loan amount, and they'll sign off. You pretty much get the loan. And a lot of these loans, you can get Freddie and Fannie. So those are insured backed. So those are really good loans to get. What's wonderful about these loans also is they offer interest only options. So most of them offer maybe 3 years interest only, which is great because that means in those first 3 years, you're only paying the interest on these loans. So you're cash flowing a lot more, and you'll start, paying off year 4, 5, and 6 and to include that principal amount. But in those first 3 years, it's really great. It allows you some time to stabilize your property and collect on that cash flow. The rates here are really great right now. These are 5 to 6.5%. And if you know what the rates are today on conventional financing, which is, as of this morning, was about 6.5, the rates on these are a lot lower. And lastly, you have other options. The market has been very difficult lately. So we've had to look at other options such as seller financing. A lot of these numbers did not work unless the seller was willing to negotiate and be able to, work with us. And we were able to manage that. We'll show you some examples at the end. Also debt financing, bridge financing. Bridge debt is really good in a sense that they give you some really competitive rates. However, for those, you really have to have some sort of value add in your property where you can maybe renovate some of the units and bring the value up. These are shorter term loans, so like 3-year loans. And, you pay a little more than you would for that $1 million+ loan amount. And of course, there's hard money. If you must have to close your property because you just can't, let this one slip through your fingers, you can look at hard money options. Those are a lot more expensive. In short, really, you can make any deal work if the income is there, right? And if the expenses are low enough. And we're going to go over that in a little bit.
All righty. We're going to move right on to determining the value of properties. One thing Brenda's already kind of touched on this. If it's 2 to 4 units, it's just like a single family. They're going to use sales of comps instead of income approach. So we're going to go over the difference between the two of those. And also looking at the pros to going with the sales comp and value add versus something that's a little more rent ready. The first one, well, I'll start down here at the bottom with the market at 315,000. Say you buy a property at 315,000, fairly turnkey property. Your monthly rent is $2,300 a month, and you can potentially get to $2,650. Okay, you don't have a lot of room to grow right there. You're going to get in there and do a little bit of value add to it. You're going to do some work, getting the units prepared, getting the rent bumped up to $2,650. And, it's going to take some time to get it there. And like I said, there's just not, you don't have a lot of room to grow versus if you go in and you buy a property same type of property that needs some value added, 250,000. You're getting a discount on the property. The rent is already $1,500 a month, but you can get to $2,500 a month. Now, you are going to have to get in there. You're going to have to do this work yourself. It's a lot harder than something that's turnkey, but the plus to this is you have so much more room to grow. You bought the property at a discount at $250,000. You work the rent up to, now you're up to $2,500 a month. You're cash flowing so much better than you were to begin with. Plus the extra equity that you have built in the property. I mean, 315,000, you might get an extra 10,000 in equity. But I mean, here you are, you're at $75,000 in equity is what you're looking at that $250,000 property. So sometimes value add, even though it's a little more work, that's going to be what really makes a difference for you on your cash flow in the future. Anything you want to add on that one, Brenda?
No, I thought that was excellent.
Okay.
So now we move on to the 5-unit plus, and I hope I don't lose some of you here because it does get a little bit more complicated, but you should all know this because you are going to eventually move up to these bigger units. So unlike the 2 to 4 units and the single family, they do not use the sales approach, the sales comps approach, like Mike just said. Here you look at NOI and you look at cap rate and you look at value. So I know some of you are thinking, what does that mean? So I'm gonna actually get out of this little screen here and I'm gonna show you this other sheet here. Mike, can you see this sheet? Are you able to see the sheet right now that I just showed?
Yes.
Okay, wonderful.
Yes, it's up.
Okay, so this sheet here is an income statement. This is what a property manager should be giving you every month. It shows you your income, what you're getting per line item every single month. You can see here the income totals $13,200 that month. The next item is the operating expenses. That's the section in the middle. That is what your expenses are that month, right? These include taxes, insurance, maintenance, every single line item. So once you subtract your gross income, which is at $13,200, minus your operating expenses of $6,119, what you're left with is $7,081. That is what we consider your net operating income. So this is your income before you pay your debt service. So before you pay your mortgage and your interest. Why? Because everybody can get a different type of loan, right? I'm not going to get the same loan the next guy's going to get. So we all want to have a comparable that is across the board the same. So we all look at the net operating income. So keep this number in mind because now that I go back to our presentation, I will show you here what we mean by this. So again, this is the formula, NOI, right? Cap rate, what is a cap rate? That's determined by the market. So for example, I'll show you if we have a property that's earning $27,000 over the year. So this is annual in NOI. So at the end of the year, after you've paid all your expenses before your mortgage, you have $27,000. What is the cap rate? The cap rate is market determinant. So for Chattanooga, right now, the cap rate's about 5.4%. And that's really determined by the drive, the demand in that area. And so if you divide 27,000 by 5.4, this property should sell at 500,000. So that is how we determine value. So now let's look at an example, and I hope I'm not losing some of you here. So a value add example so you can see how easy it is to increase not just your cash flow, but also so you can see how easy it is to increase the value of a multifamily property. I buy a 10-unit apartment. I decide to install washer and dryers in every unit. And now I decided I'm going to charge my tenants $35 per month for the use of those washer and dryers. So at $35 a month times 10 units times 12 months. I've just increased my income by $4,200. If we use that same formula on the right, your value just increased by $77,778. That means your new value for that property for just installing washer and dryers has gone up to $500 and about $78,000. That's how easy it is to add value on these properties. This is how they are appraised. They look at your income. They want to see what your net operating income is. What is a cap rate in that region? You divide that, and that's how you come up with your value. So I hope I made it easy enough so that you understand that even simple items like adding washer and dryer, charging for parking, you know, a lot of you who are still maybe potentially looking at rental properties, you can see that some charge for rubs, right? They charge for utilities, and they charge for every single little line item, application fees, credit checks. All this additional income really helps push the value of your property. So if you can operate these efficiently, right? Because there's still expenses involved with washer and dryers, but this was just a quick way for me to show you how easily you can increase value. If you can operate this efficiently, you can increase the value of your property substantially.
All right, next we're going to talk about your pre-inspection checklist. These are the things that you need to look for yourself to make sure this is when you're determining, is this a good deal for me to put an offer in on? And, you know, I'd like to take this time to just really express to you that it's really important that you as an investor, you do this yourself. Whether you're working with Morgan and Maz or you're working with another group or agent or, you know, whatever market you're in, don't ever trust the agent to know everything. You know, we're going to guide you the best way of our ability. We're not going to steer you wrong. But at the end of the day, this is your transaction. And these are the things that you need to know and verify yourself. That way, you know for a fact. And some of those things are your rent roll, what their rent amounts are. Um, is there any additional income that's coming in? Um, you know, like Brenda was just talking about for, you know, whether it be pet deposits or things like that. Delinquencies, the tenants that are there, are there any delinquencies or are there any delinquencies whatsoever from the landlord themselves, from the owner? Find out the lease expiration dates, any lease information that they have, and of course the security deposits. If you buy the property, you know, any security deposit that's going to be transferred over to you. So you want to make sure and verify that they're there because it's rightfully yours if you close on the property. Your P&L financials, audit expenses, property taxes. You need to know what the property taxes were. Very easy to find. You can get those off the tax card. And insurance. That's one thing that we'll also, one of the things that we do here at Morgan and Bonds, we help. We have a contact list. We can get you in touch with insurance agents for homeowners insurance and renters. I mean, not renters, homeowners. But you need to verify what the insurance is going to cost for the property to figure into your numbers. Your pro forma, what the rent's been, what the rent could be. Also, you're wanting to check what the market rent actually is. You want to be able to confirm that for yourself. And here we are. Is it in a flood zone? Again, very, very easy, especially in the Chattanooga market. We have the CRS tax card. Just pull up the tax card, scroll to the bottom. You know whether you're in a flood zone, that property is in a flood zone or not. If it is in a flood zone, in some cases, that's not a big deal. You just have to figure that extra insurance, that flood insurance, into your numbers to make sure it's going to work. In other cases, and that's where we come in, you know, knowing the area and the market, you know, it may be a property that is just, you know, you don't want to have nothing to do with. Are there any insurance claims in the past? I believe it's 3 years. Is that right, Brenda?
Sometimes it can go up to 5.
Up to 5. Deferred maintenance is is the HVAC, is it running on its last leg and they just come out there every couple of months and shoot some Freon in it and it really needs to be replaced? Those are the kind of things that you need to check for. Yeah.
Yeah. So, I mean, before we even get started on doing any type of analysis, you should ask for these items from the seller. These are necessary. And that's where we get into analyzing a deal. Okay. So I stress this to you, keep it simple. You're going to get so many deals come across your desk if you're looking for them. Maybe 98% of them are not good deals. So we need to analyze deals and we need to analyze them quickly. So the best thing to do is to just keep it very simple. Don't waste your time. A lot of us see a deal, we get almost emotionally attached to it. You start thinking, maybe if I do this, maybe if we do that, we can make it work. If you start questioning yourself already, that's probably a bad sign that you're already going to be stretching yourself thin or putting yourself in a situation where that deal is going to, not work out in the end. It's always better to miss out on a deal and wish you had, possibly gotten the deal than to have a deal that went bad and wish you never had done it. So keep that in mind. Also, always buy for the right price. So now I will go into a quick analysis just to show you what that means. And here we have a quick rental property analysis spreadsheet. You can create this yourself. This is very easy. What I will tell you is you'll find a lot of gurus out there that will sell you these pro formas that are really elaborate, but you're probably never going to get there. And so it's overwhelming to think, how am I going to analyze a property when I have to fill in all these formulas, all these boxes with some other tools? Guess what? Like I said, keep it simple. You don't want to waste your time in trying to find all these details to put into your spreadsheet if the deal's not even going to work. So let's just look at it really quickly based off of what a seller may give us, right? So if you remember that deal that Mike told you about, it was a value add, 250,000. They were getting a rental income of 1,500, right? Down payment is 62.5, considering that the lender says, hey, I need 25% down, which is sometimes what they ask for. You want to have a $20,000 renovation is what we're estimating because, it seemed like a heavy kind of value add since the rents weren't up to market. While this deal, you're losing $276 every month. Now you can look at it two ways. You can say, I don't want this deal. This deal is not going to work for me. I'm going negative every single month, right? If you look down on the yellow portion here, you can see year one, you're losing $1,217 if the rent were to stay the same that entire year. However, if you stick with this property, even earning $1,500 going forward forever, year 5, you're already have a return of $1,138. Why is that? It's because you're paying down that mortgage, right? Every year. So you're building some equity in your property. Now, keep in mind, these numbers in the yellow do not take into account depreciation and deductions. So that return actually is going to be a lot nicer for you once you're done with your taxes. But let's just say for the sake of today, I'm going to feel having to pay out $276 every month. I don't want to do that, right? So what is the other way I could look at it is, well, what if I bring those units up to market? Remember, the market was $2,500. So let's change the rental income here to $2,500. Now you're cash flowing $454 every single month. Now this deal actually looks quite good, because if I just do the work that I need with that 20,000, renovated, get some tenants in there, push those rents up to $2,500, now I'm actually cash flowing $454 every single month. That's nice to have $500 or $454 in my pocket every single month. Guess what? At the end of the year, after your mortgage is paid down a little bit, you get that equity, you've actually made $7,543. So your cash on cash is almost 6% that first year. Going forward, every year ahead, even with depreciation and deductions, these numbers start looking much better. So it's really weighing a deal. Can I bring up that income? Can I reduce the expenses? Right? So that's a way to look at this deal. Now, what about if we had bought it at market? Let's say, I think it was 315, we said, Mike?
Yes, 315.
So at 315, I bought a property that I feel better about because it's cash flowing. I don't have to put money out of pocket every month. But guess what? I'm only cash flowing $97. And those rents are probably not going to go much higher, right? Because I think the market was like 2650. So let's change this to 2650. I raised those rents up to 2650. Yeah, I'm cash flowing $207. But I'm also paying mortgage on a much higher loan amount, right? So those are the ways you have to weigh. Do I want to do this deal or not? And this is a very simple way of just doing it with a quick spreadsheet, nothing elaborate, for you to see, how do I feel about this deal? Do I want to do this deal today? Because today I'm paying more at 315, but if I'm only earning 2,500, I'm still only putting $100 in my pocket. But if I did the other deal at 250, right, and brought those up to market, I think they put 2,400 or 2,500. That net cash flow every month looks really attractive. So it's really an analysis, right? And that's why it's very important to get those items from the seller before you even step foot on that property, because you may not want to even waste your time. So this took me maybe, I would say, hey, 15, 20 minutes to hassle the agent to give me these documents, another maybe 20, 30 minutes to enter it in this spreadsheet. And I know right away, do I want to do this deal or not? What's my alternative? Easy peasy. Okay, we can move on and move into the proper analysis of this property, and I can actually go into inspection because it's worth my time versus, do I really want to spend an hour filling in this pro forma sheet, that some guru sold me for $10,000, because yes, some of them cost that much. But it's simple back of the napkin analysis. Does it work for you or not? That's what it comes down to. Don't waste your time. Time is money. Let's not waste it analyzing deals that are not worth your time. So now we'll go back to the presentation, and I'll let you take it from here, Mike.
All righty. So we're now we'll talk about the next steps. You got the property under contract. We schedule the inspection. We always recommend that you do a termite inspection as well, especially here in Chattanooga. One thing I'll tell you that you have to look out for is moisture. The moisture we have, so that brings termites. So it's always good to check for it. And of course, your regular home inspection. You got to get accurate quotes. The main thing is to build a team prior to this. That way you have all your team members in place and get your accurate quotes for your repairs, get your contractor involved. What is it going to cost in maintenance and in repairs to get this to build it up to the rent market or the rent rates that I want to get it at. Shopping for loan options. We have several different conventional lenders here in the Chattanooga market. You may want to use your own wherever is local to you, but it's always wise to shop around and see what rates you can get. This closing cost may be a little bit cheaper than the last lender you spoke to. So, be sure to shop around and see what you can find. And conduct your own market studies. You want to know, is the ARV that this agent gave me for this property, is that accurate? You want to make sure and know that for yourself. And of course, determine your business plan from start to finish. How are you going to run this? And the goal, simply the goal is just to refine your analysis. to where it makes you the most knowledgeable to the market and you get the right property for you. Like Brenda said earlier, you'd rather miss out on one and wish you had it than have one that you wish you never saw before in your life.
So really it's to make those numbers work, right? So here are some samples of what we were able to do with some creative financing because of the market being the way it was, which with really high rates. We had to talk to the seller, get some seller financing on these. These are furnished midterm rentals. These are 9 units. Cash on cash is 8.25%. And the monthly cash flow on this is 2,100. So this is a good deal. And there was really no value add here. There was no rehab we needed to do. These were ready to go. They were immaculate, well taken care of. So these were honestly a good buy. And we had to wait. We had to wait and negotiate this one with the seller, but we were successful in doing that. The next one is really a home run deal. This one is a 10 unit. As you can see, the cash on cash, I'm not kidding you, is 21.9%. That's incredible. And we were able to do that. Why? Because we negotiated this creative financing. So 2 of the properties, this is a portfolio of 3 properties. 2 of them we did with conventional loans because they were a duplex and a triplex. And the last one was a seller finance loan. And that one, we were able to negotiate an incredible rate. Why? Because this owner just did not want to have these on their books anymore. They had a horrible property management company. They wanted to sell it, get rid of it. Guess what? We were able to turn these around very quickly, have Section 8 tenants. And guess what? With the rent in that area for Section 8, it was a lot higher than what the rents were being charged at the moment. So we were able to increase those rents immediately and get a really good cash flow on this. So cash on cash, 21.9%. It's really unheard of. So with that said, stay connected with us. We're here. We can be your resources. We have weekly newsletters that we send with all the market trends, what's going on, not just in the real estate market and locally, but what's going on in the economy. So some of you might have received that. You see, we really dive into what's going on with the stock market, what's going on with the Fed. And why do we do that? Is so you can be a holistic investor. And that's why we put these educational webinars together, is for you to really come into the market knowing what you're doing. And we're here to support you along your path. We enjoy doing this. It's something that we provide for you as an additional, resource. And of course, some of we do video tours, so you do not have to live there. Actually, the majority of the clientele is out of state. And like Mike mentioned, we have trusted partners from lenders, general contractors. We even have potentials to build partnerships here. So let us know. You can get daily listings from us. We're here. Follow us. These videos will be put on YouTube. We have a Facebook and we have an Instagram. But aside from that, just stay connected with us. Obviously there's other things in multifamily that we didn't get into because, I'm not sure if some of you want to get into syndications and all of that, but there's opportunity for us to get into all of that in the future. There's going to be more webinars coming, and we're going to see what topics are the ones that seem to resonate with people. This topic actually came up because we had a few of you that are looking at this, 5+ and duplexes. So we thought, let's get this information out to them because maybe they'll see it from our perspective when we're looking at a deal, but also be easier to have that conversation on how we can make deals work. So we hope you found this very valuable. And of course, we thank you all for your time, and we will open it up now to Q&A.
Yes, I did see that we had a question in the chat earlier. To answer your question, we're in Chattanooga, Tennessee. Brenda's in LA, of course, but the market that we're working with is Chattanooga, Tennessee.
Okay, so I see a question here. It says, for commercial multifamily properties, how can we find properties that Fannie Mae confiscated because the owner cannot perform? And would those be good properties to possibly purchase? Okay, so honestly, Fannie Mae is not the one who's going to be confiscating these loans because Fannie Mae is kind of the insurer. It would be the actual lender or servicer, right, who confiscates these. And usually they have an in-house team that then takes over all these properties. Unfortunately, this also means that they turn around and give them at a very good rate to some of their buddies in the institution that are mostly institutions. So you and I probably will not see these. Now, when it comes to the smaller stuff, say where it is one of those properties that got the under $1 million loan price, they're with a federal credit union or your local bank. Those local banks usually host or hold their own auctions. Sometimes they do it maybe once a month. It ranges, and they all have their own processes. But those are good to check with those local banks and see how they're choosing to deal with those. Because sometimes they just hand them off and keep them on their books, and they hire a property management company and stabilize them and keep them on their books for a while. And then they'll try to regain that value back by selling it themselves at a later date. So that's what we're seeing also in the bigger multifamily space as well. Do you offer a list of assets you are looking to work on? Hi, Kim. Thanks for coming. So I'm assuming you mean some listings. We do have listings that we're constantly looking at. So Mike and I, we're on the MLS every single day. And
Yes.
so I tend to look more at the multifamily stuff and the fix and flips. Mike looks at everything. So yes, one of us is always looking at it. And if you want, I can reach out to you after and we can get your criteria of what you're looking for. And we'll set you up on those daily listings so you can automatically receive an email every day with the listings that fall within your criteria. So you can look at them, and anytime you have a question, you can give us a ring or a text, call, anything, and we can find, comps for you, get a video tour going, whatever it may be. But it's a good way to just see what's out in the market.
Mm-hmm.
Yeah. Any more questions? I hope it wasn't too complex to understand. Read the 5-unit plus. I know it gets really dense. Any more questions? No. Well, I know we have been seeing a lot of duplexes come on the market lately, and they range in different conditions, different incomes. So it's finding those little gems that, you will be able to increase the value, or I wouldn't say value because like we mentioned, they're set based on sales comps, but increase that cash flow for you every month. So what I would say is that the market is really heating up right now, especially with the anticipation of those rates coming down and seeing more people flood the market that have been on the sidelines. So it's a good time to just keep an eye out and start seeing what is out there so you have a baseline. Mike, do you want to take the last question?
Yeah, we actually, thanks for asking, James. That's a great question. We do see multifamily in all classes, A, B, and C. However, well, through all classes, A, B, and C, there are fewer multifamilies than there are single family. But I would say the A class, you don't see very many in it, but they are out there. That's one thing that's going on at the moment. There's so many different areas in Chattanooga that are being revamped and built up. We have a lot of duplexes and quadruplexes going up in B class areas, or in, I should say, C class areas, and they're pushing those areas to B class areas. But I would say mainly C and B, but they're all across the board. And I hope that answers your question, James. And Shay, thank you for that. We really appreciate that.
Absolutely. Yeah, so I guess if no one has any more questions, feel free to reach out to us anytime you do have a question. Of course, we're here. Um, and look out for our future webinars. We're still deciding on a topic, but I think that will be driven by, you all and what you want to see. So if there is a topic that you feel that interests you or will help you as you go through your journey of building your portfolio, please do reach out, let us know, and we'll touch on it and help you become a much more informed investor in your journey. So thank you, everyone.
Yes, thank you very much.